There is an opportunity in crypto right now that Cathie Wood and Ark Invest believe is bigger than Bitcoin. It's an opportunity that they believe could 56x over the next couple of years. It's an investment they are currently pouring hundreds of millions of dollars into. And no, it's not a tiny altcoin. It's not even an investment with crazy risk. The 56x opportunity Cathie Wood and Ark Invest are pouring hundreds of millions of dollars into is Ethereum. And the window to position before October is right now. They've been pounding the table on Ethereum for years, and back in their 2022 Big Ideas report, they laid out a path for Ethereum to hit a $22.5 trillion market cap. That is a 56x increase from where it is today. In this video, we will dive into why Cathie is so bullish, how Ark Invest is getting exposure, and what the setup looks like heading into October. We will cover three things. First, why ARK calls Ethereum the institutional protocol and why that matters. Second, the 56x model and what has changed since they published it. And third, the price catalysts going into October, including treasuries, staking, burn, and a looming Ethereum supply shock. And we will hear from Cathie Wood in her own words throughout. But before we jump into it, only a small percentage of you are actually subscribed. If this helps you navigate the next 8 weeks, hit subscribe. It is free and you can always change your mind later. Every crypto cycle rhymes. In post-halving years, Septembers have a habit of shaking weak hands because on average, it's the worst month for crypto by far. But just wait. October to December is where the big moves start to accelerate. In general, September shakes people out. Q4 is where the gains are made. If you believe ARK's thesis, the play is simple. Accumulate into September fear. Be positioned for the rebound in October when flows, headlines, and seasonality often flip. We will map the catalysts so you can decide if that fits your plan. First off, here's why Cathie is so bullish on Ethereum right now.
We've been evolving our point of view on Ether. When we started our analysis, we were pretty much, and this was with Chris, Bitcoin was what we needed to understand first, but we were keeping our eye on all of the other assets, and we stuck pretty closely to the thesis, the FAT protocol thesis that Chris's partner Joel Monegro came up with at Union Square Ventures, which says that the value accrual will take place more at the currency level. And we believe there would be only a few currencies in the world, much like there are today. We thought Bitcoin would be the reserve currency, and we were looking for the other currencies. And Ether was showing up as a very strong second. And I have been surprised at how Ether and the Ethereum network is mushrooming with stablecoins, NFTs, decentralized finance. It's clearly satisfying a huge unmet need. I remember saying very early on, follow the developers, follow the developers. Well, using that metric, Ethereum is off the charts, whereas Bitcoin is steady as she goes, still increasing, steady as she goes. But clearly, Ethereum, decentralized finance, NFTs have hit a responsive chord.
Cathie's logic is simple. Follow the developers and where they are building. And the platform that has by far the most developers and builders, Ethereum. Talent votes with their time. Ethereum has become the default build layer for stablecoins, DeFi, NFTs, and now tokenized funds and real-world assets. That base attracts users. Users attract capital. Capital attracts institutions. Cathie also is so bullish on Ethereum because it is one of the few cryptocurrencies that can provide yield. In case you didn't know, if you stake Ethereum, you receive a yield. Think of it like receiving a dividend. Ethereum fulfills an unmet demand for yield and is a more efficient financial stack. In a world starved for real return, staking and protocol fees become a magnet.
One of those needs is yield out there. And we see that in the fixed income markets, the ridiculous rallies that have taken place, taking junk bond yields down to, just a couple of 100 basis points above treasuries. That's kind of nuts. So this hunger for yield is being satisfied by a much more efficient financial ecosystem. And I think many more people are more open-minded to it as well.
Yield, throughput, and developers building are not hype, they are rails. Rails pull in demand, and demand pushes prices higher. This leads into why Cathie believes Ethereum is the institutional protocol and why it's going to attract a tsunami of institutional money over the coming years.
Yes, we have been watching carefully who is signing on to what protocol as they begin to develop their digital asset strategies. So, well, first we saw Coinbase for its layer 2 base chose Ethereum. More recently, we saw Robinhood for the layer 2 that it is evolving, also building on top of Ethereum. We had a thesis that Ethereum was going to be the institutional protocol.
When Cathie says Ethereum is the institutional protocol, she is saying the big serious players are picking Ethereum as their home base. That matters because institutions are steady, deep-pocketed buyers. They do not flip in and out, they build products, hold working balances, and stake for yield. All of that soaks up supply for years. At the same time, activity on Ethereum destroys a small amount of Ethereum with every transaction, so the pool of coins slowly shrinks. More long-term demand, less liquid supply. That is a simple recipe for higher prices over time. Add one more flywheel. When banks, brokerages, and well-known brands choose Ethereum, more developers and users follow. More usage means more fees burned, more staking, and more reasons for treasuries to add. The loop reinforces itself, and price tends to catch up. Okay, but how does Cathie Wood and Ark Invest think Ethereum can 56 times over the coming years? Well, in their Big Ideas 2022 report, Cathie's team thinks a huge chunk of finance moves onto Ethereum over this decade. Payments, lending, trading, tokenized funds, and stablecoins all run on the same rail, and the token that powers the rail is Ethereum. As that activity grows, more institutions hold Ethereum for working balances and stake it for yield, which takes coins off the market. At the same time, every transaction burns a little ETH, so the total pool slowly shrinks. More long-term demand, fewer coins for sale. That math is how Ark gets to roughly a $22.5 trillion Ethereum market cap, about $185,000 per ETH. This was a decade-out view, not an overnight trade. And since 2022, the tailwinds have only got stronger. It is easier for big money to buy and custody Ethereum. Companies are building Ethereum treasuries that stake their Ethereum, and exchange balances are at multi-year lows. Here's why that matters right now. It's finally getting easy for big players to use Ethereum. Spot Bitcoin ETFs opened the door for institutions, and we saw what happened with its price. Ethereum products are now following. Major brokerages and banks are turning on the on-ramp so clients can buy, hold, and custody Ethereum without hacks or headaches. Companies also have a clean way to own Ethereum through treasury vehicles that can stake and earn yield. Less friction, more steady buyers. And we can see the votes in the real world. Coinbase Base is built on Ethereum. Robinhood's new layer is building on Ethereum. Stablecoins mostly live on Ethereum. Tokenized funds and payment pilots are launching there first. When real firms choose one chain for real money, they bring users, fees, and long-term holders. That snowballs and price usually follows. This shift in institutional buying can be seen with Cathie and Ark Invest themselves. Despite them being extremely bullish on Ethereum for years, they had no good way to hold it, so they couldn't pour hundreds of millions of dollars into it until now.
It was very, very difficult for us to gain a position in our ETFs with good exposure to Ether. There are all kinds of problems when 40 Act funds buy another fund, another ETF to gain exposure. There are tax issues. There are fee issues, fees upon fee issues. There's something called, and this is a tax issue, bad income. If the profits associated with something generating bad income, bad doesn't mean evil at all. It just means it's a tax term. If those profits, gross profits, this is gross, there's no netting here. If those gross profits are more than 10% of the total profits generated in a year, of a fund, the entire fund can be shut down. The tax benefit, you'll basically lose a lot of tax benefits, and you'll be subjecting the fund to a great number of fines, if not actual shutting down. So we can't take those risks. And as you can tell, I'm not deep into tax law, and I'm not going to be able to explain exactly who, what, when, where, why, and how. I just listen to our trading team, our compliance team, our finance team, and I say, okay, I can't go there. It's just, I can't do it. So this is the first time we've been able to gain a solid position in Ether.
Now, with Ethereum treasury companies, the floodgates for institutions buying Ethereum just opened. This is why Ark Invest has been buying large stakes in Tom Lee's Ethereum treasury company. Their current buys add up to around the $200 million mark. Cathie Wood and Ark Invest are not alone in their huge predictions for Ethereum. Tom Lee calls this Ethereum's Bitcoin 2017 moment. He believes Ethereum can 10 times over coming years. He made the same 100x call on Bitcoin when it was near $1,000 in 2017. He was early, loud, and directionally right on the magnitude. His firm is acting on that view. His treasury company Bitmine has accumulated more than $5 billion in Ethereum within weeks, over 1% of supply, with a stated goal to reach 5%. They have since raised additional capital, and Ark has been buying up large equity stakes to get. The reason why this matters is because every treasury company that buys removes liquid supply. Treasuries do not trade like retail. They size, they hold, they stake, and they raise more to buy more. That creates a rising floor under price action while increasing reflexivity at the top. Here's another reason why Ark Invest and institutions are so bullish on Ethereum all of a sudden. Since the merge, very little new Ethereum has been created. On busy days, the total supply can even shrink. Every transaction also burns a tiny bit of Ethereum, so as activity rises, the pool of coins slowly gets smaller. At the same time, a huge amount of Ethereum is staked or locked in smart contracts, which means far fewer coins are sitting on exchanges ready to sell. Now, line that up with demand. Corporate treasuries are buying, banks and brokerages are making it easier to hold. Layer 2 networks are pushing more activity through the system, which increases the burn. You end up with fewer coins for sale and more people wanting them. This has led to the lowest amount of Ethereum being held on exchanges in years. That is how a supply squeeze happens. It is not magic, it is just how the market works when thin supply meets fresh demand. Prices do not drift higher. They can gap up violently. Another reason Cathie is so optimistic about Ethereum is stablecoins.
So we've been watching the stablecoin movement, which is exploding. And of course, again, most of that is happening on Ethereum.
Here is why that matters. Stablecoins are just dollars on the internet. They move fast, settle anytime, and plug into thousands of apps. Ethereum won the early race with the big issuers and institutions. Ethereum has the best wallets and the deepest liquidity, so more than half of the stablecoin economy lives on Ethereum and its layer 2s. Developers ship there first. Exchanges and payment apps integrate it by default. That flywheel keeps pulling even more activity onto the same rail. Now look at where this is going. Stablecoins are spreading from trading into real life. Cross-border payments, online checkout, freelance payroll, business treasuries, tokenized funds that pay yield in dollars. As banks, fintechs, and brands hook into that, the stablecoin pie can grow by multiples from here, and a big slice of that growth will keep landing on Ethereum. Why is that bullish for Ethereum? Every dollar that moves on Ethereum needs the network. More use means more transactions, more fees burned, and more reason for companies to hold a working balance of Ethereum and often stake it. That shrinks the liquid supply while demand builds steadily. Over time, that setup is simple. More real-world use, fewer coins for sale, upward pressure on price. Ark Invest's 56x prediction is not hype. It comes from two simple ideas. First, use. If more of everyday finance moves onto Ethereum, payments, savings, trading, tokenized dollars and funds, the network gets used non-stop. Real activity all the time. Second, supply. The number of coins people can actually buy keeps getting tighter. New Ethereum creation is low, a little gets burned with every transaction, and a lot is staked or locked up for the long term. Put growing use together with fewer coins for sale, and over time, price pressure builds. That is the logic behind Ark's 2022 map to a $22.5 trillion market cap for Ethereum. It will not be a straight line, there will be big pullbacks, and it only works if real-world usage keeps growing. But that's the simple reason they think Ethereum can go much, much higher. Tom Lee is a Wall Street veteran that agrees. He believes Ethereum now is Bitcoin back in 2017. The breakout, the under-owned asset, the new treasuries, a product wave that opens the floodgates. He points to a 120 times precedent in Bitcoin. He is applying the same corporate treasury strategy, just faster and focusing on Ethereum's broader utility. Whether you agree with a 100x or not, the point is the trend. An under-owned asset can reprice violently when the buyer base expands and the float tightens. Your job is not to get tied to a specific number or price target. Your job is to understand the setup and decide your risk. Even if you agree with Cathie Wood and Tom Lee and think Ethereum could go multiples higher from here, there are some risks you must respect. Volatility is part of the game. If Ethereum runs early, it can snap back hard. If September turns red, treat it like a shakeout, not a broken thesis. Hype can get ahead of reality. When headlines get silly, stay calm. If you catch yourself adding leverage, cut it before it cuts you. Your biggest enemy is emotion. People panic at bottoms and chase at tops. The real risk is not a dip. It is getting shaken out before the big move finishes. Write your rules now before the action starts. Then follow them when it gets loud. As we push deeper into the cycle, there are a few simple signals to watch. First, look at Ethereum on exchanges. When that number keeps dropping, it means fewer coins are sitting there ready to sell. Tight supply is a good sign. Second, check how much Ethereum is staked. A higher staking share means more coins are locked up earning yield. Locked coins do not hit the market, which helps price over time. Third, watch the burn when the network gets busy. More activity burns more Ethereum. That slowly shrinks the total pool. Fourth, keep an eye on Ethereum versus Bitcoin. If the Ethereum chart starts trending stronger against Bitcoin for weeks, that confirms rotation into Ethereum is underway. Finally, pay attention to real-world headlines. New brokerage access, new corporate treasuries buying, and any rule changes that allow staking inside products. These show fresh demand coming in. None of these will call the exact day to buy or sell. They tell you what kind of market we are in. Use them to size your positions and time entries on pullbacks. Check them weekly, not hourly. Here's something to keep in mind. September is usually messy. Treat it as a month to build, not chase. If you agree with Ark's view that Ethereum is the institutional pick with 56x long-term upside, then red days in September should look like opportunity. Historically, October, November, and December is when momentum often returns as money flows back in and the story tightens up. Line that up with what is happening under the hood. Treasury buyers are taking coins off the market. Staking locks up more Ethereum. Real usage burns a little with every transaction. Less supply, steady demand. That supports higher prices over time. Can we time it to the exact day? Number. Do we need to? Work with a window. Write a plan. Stick to it. Here is what to expect. Ark Invest is not trying to time every Ethereum price wiggle. They want steady exposure that builds. That means buying up treasury companies that can stake Ethereum, earn a yield, and hold for years. Treasury companies are now racing to be the biggest Ethereum treasury, the way MicroStrategy did it with Bitcoin. They raise money, buy Ethereum, stake it, and keep stacking. Price swings do not scare them. Red days are just cheaper inventory. Green days confirm the plan. Their goal is simple: own a larger slice of the network over time. Think in percent of supply, not in daily price. While most people watch candles, these firms watch how much they have staked and how fast they can add more. This behavior matters for you because it takes coins off the market and keeps them there. Less supply on exchanges, more long-term holders. A stronger floor under price as real usage grows. Think in time windows, not exact prices. If you want to take some chips off the table, decide the window you plan to sell into, then stick to it. When the market gets wild and euphoric, take a small slice for lifestyle chips. That locks in, wins without abandoning the move. Keep a core position riding the long-term trend. Set aside some cash now so you can buy the next big dip. You do not have to be perfect. Your job is to stay in the game long enough to win. Write down your plan for September and October. If you share Ark's view on Ethereum, buy on red days instead of chasing green ones. Check the basics once a week, exchange balances, how much Ethereum is staked and how much is being burned. Tight supply is your friend. Watch Ethereum versus Bitcoin. If Ethereum keeps trending stronger, that confirms rotation. Size position so you can handle swings. Skip the leverage. Choose your lifestyle chips percentage now. Do not decide in the heat of the moment. Keep some cash ready for after big spikes. The best deals show up when the crowd is scared. If you want the key signals in 5 minutes a day, my newsletter covers exactly what to watch. Treasury buying, ETF rule changes, exchange balances, and rotation tells. More than 90,000 readers use it to act with clarity. First link in the description. Enter your email and you are in. Here is why Cathie Wood and Ark are so bullish. The builders are on Ethereum, the big brands and platforms keep choosing it for real products. Stablecoins mostly run on it. That pulls in users, then capital, then institutions. On top of that, Ethereum can pay a yield when you stake it, so companies and treasuries are happy to hold it for years. Now layer in the supply side. Since the merge, very little new Ethereum is created. Every transaction burns a little. A huge chunk is staked or locked in contracts. Treasuries are buying and not selling. That means fewer coins on exchanges while real use keeps growing. More steady demand, less liquid supply. Over time, that is how prices move higher. That is the simple logic behind Ark's 56x prediction. It is not a tomorrow call. It is a multi-year view as finance moves on-chain and Ethereum becomes the default rail. If that plays out, the path to much higher valuations is realistic, not fantasy. And here's what that means for us. Treat September as a month to build your plan, not chase candles. Be ready for October and beyond. Keep a core position you can hold through noise. Take a small slice when euphoria is obvious. Keep some cash for the next big dip. Check the key signals weekly, not hourly. If you believe Cathie's thesis, time is your ally. Real usage plus tight supply does the heavy lifting. Stay disciplined, follow your plan, and let the story play out. Anyway, guys, that is all for today. Thanks for watching, and I will see you in the next one.